Good to see all of you guys. Thank you for jumping on. I know up in here in Connecticut, it's a beautiful night, so we'll try not to waste too much of it, but appreciate everybody showing up as always. And, these are fun to do in the sense that we know there's a lot going on out there that you guys have questions about, and sometimes it's just easier to hear it from the horse's mouth. So, without further ado, I'm bringing in Eric Parnell, the Chief Market Strategist at Great Valley Advisors, and many of you have seen him before. Undoubtedly, you've seen some communications from him if you haven't been on with him live. And Eric's role and our partnership with GVA is pretty robust in the sense that we leverage the resources at GVA to do a lot of what we do within your portfolios, and a lot of the work that they do on their end is reflected in what you guys see on your statements in terms of performance. So it's really important that you, one, see who Oz is behind the curtain, and two, understand what we're thinking, and you give you some open and access to Eric and myself and Preston to be able to answer your questions directly versus feel like you have to wait for an email to come through with some sort of synopsis that is outdated about 15 seconds after we finish typing it. So Eric, welcome. Thank you again for your time and expertise, and I'll let you jump right into it.
Absolutely. Thanks, Paul. And thank you to everybody for taking the time to join us on this Wednesday evening to close out the month of April. It is certainly, I mean, it's been an April to remember here in 2025 with, we came into the month and we had a U.S. stock market that was already kind of adrift. It peaked on February 19th. And, for about a month and a half into the second half of the first quarter, it had been fading to the downside. But no sooner did we turn the calendar to the beginning of the second quarter, and we had, what's kind of been referred to as Liberation Day. It was April 2nd. It was after the market closed, and basically the current White House announced their tariffs, their tariffs that they plan to impose on trading partners all around the world. And that really served as a catalyst to unleash a tremendous amount of market volatility, particularly in the early parts of the month. So it has been, a volatile time, not only for the stock market, but also for capital markets in general. It includes bonds, it includes commodities, it includes, all different types of asset classes. And it's really been a barrage of financial news headlines that we've had to digest along the way. So, I have a number of items to talk about as we go through, but, as Paul mentioned, my role at Great Valley Advisor Group, we are, we're the investment strategy team that is behind Paul, behind Preston, in providing investment solutions for you as clients. So before I get into the things that I've prepared to talk about tonight, I just wanted to take an opportunity at the outset to kind of get a gauge. What are the things that you in your own minds as you've been monitoring the markets over the last month, what are some of the pressing questions that you may have? Are there any questions that you have off the bat that you say, hey, you know what? I'd like to dive into this topic here as we get started here tonight.
Yeah, and if you guys don't want to speak up, you could certainly type it in the chat, and we're happy to field those questions in real time. And um, if nothing comes up, I'll certainly ask Eric some questions that we get in the conference room from you and others. So there's no shortage of stuff to talk about. That's part of the problem. We don't want you here till like Friday. So
Go ahead,
This
Steve.
is this is more of a meta question, but I guess the thing is for me every day with the fire hose of news and fake news and suppositions, what is the best way for us to guide ourselves between what is real and what is noise?
Yeah, no, that is such a good question, and it's a topic that I've really talked a lot about recently because as a quick background on myself, I'm currently the chief market strategist of Great Valley Advisor Group and have done investments and asset allocation work going back 3 decades now. But I was also a full-time college professor for 18 years. So one of the things that I would always tell my students is, do your homework, and not in the sense of completing your class assignments, but it is so easy, particularly in the investment world, when the world of investments. I mean, markets are open every day. And we have three financial news stations that are on, in some cases 24 hours a day, and there's just this steady stream of headlines. It can become so difficult to try to differentiate between what's actually happening and the noise. And man, there has been a lot of noise over the last 3 or 4 weeks in the month of April, in terms of what's going on in the economy and the markets. For example, it was not uncommon, and it's still not uncommon at this point, to open up, say, like the Wall Street Journal, and or any kind of other financial news source, and you see these headlines talking about inflation, and the impact of tariffs, and it's going to be an inflation problem, and stagflation, which is an economic recession coupled with inflation. And there's so much information and so many opinions out there that you have to sort through. So I always told my students, I said, do your own homework, and do your homework. You'll hear all of this information out there, but it's always important to go and verify for yourself to see if what you're hearing is what's actually happening. And there has been a huge disconnect, I'll have to say, in terms of what we've seen go on over the last month in particular, and what the hard data is actually telling us. So for that, there's a couple slides that I have. So why don't we and you know what, instead of going into the slides, I'm going to do something else here. This is kind of an audible, and I'll actually drop this into the chat as well. So as I go through these things, you can take these things down, because another thing that I used to always prioritize with my students, there's no better data sources to access than the ones that are free. So some of these data that I'm going to go through to talk about what the hard data is telling us, this is information that you can get for free out on the internet. So the first one to talk about.
And
So
Eric, before you go there, I know that not everybody has the technical expertise that Eric does to be able to dive into some of these charts and really understand what they mean, because they can be confusing, misleading, and just in general hard to understand in some cases. Generally what I tell people when they ask me that question, Steve, is look at your source of information. Is it from a very politically charged outlet, right? And we all know there's certain ones that lean heavily to the right and some that lean heavily to the left. But there are some that are a little more neutral. So if you're just looking for good quality content, sources like Bloomberg or Reuters, the Financial Times, those tend to be more reliable sources. To Eric's point, not all of it's free. And you may get a couple of articles free a month, but other than that, you need to buy the all access pass. And even CNN is charging for their market commentary these days. So I would say stay away from some of the mainstream stuff that is really more clickbait than it is qualitative content and really good analysis of that, and go towards more centrist type publications that actually have some really good writers behind them. And of course, there's going to be opinions no matter what, right? We all have our opinions. There's no such thing as data that we're going to look at today. Even what Eric's going to share is his opinion in some ways. So with that.
Thanks. I'm listening a lot to Paul Krugman.
And now, yeah, that would be, there's a variety of good voices out there. One of the things that I would always encourage is to, gather together a collection of different voices. Because, Paul Krugman, an experienced economist, a lot of good insights, but also has an opinion that resides on the political spectrum. And that's not saying that that's right or wrong.
Yeah, I understand, and I understand that, and I sort of put the side. What he's good at is explaining the economic backdrop of all of this, of things I'd never heard of before. So he's a good explainer.
Yeah. So the first item that I'm going to go through here, and you can go to Google, and it's this simple. If you go to Google and you type in 5-year break-even inflation rate, this is hard data. This is what the market is pricing in. If you operate under the principle that price is truth, there's going to be a variety of opinions out there, But more often than not, what the market is pricing, the market is highly efficient because there's so many participants that are allocating to the market that it leads to an efficient outcome. The market, more often than not, will tell you the best answer in terms of what to expect. And if you type in 5-year break-even inflation rate, and this is one of the slides that I have in my chart, but I'm going to show you where you can derive it from because we finished talking today, and you may be 2 weeks from now, and you say, well, hey, I wonder where that indicator is that Eric Parnell was talking about on that presentation. You type in 5-year break-even inflation rate, and you click on the first link, and it'll take you to the St. Louis Fed. This is the Federal Reserve Bank of St. Louis that publishes this data. This is telling you what the market itself, not what somebody thinks, but what the market itself is pricing in terms of average expected inflation over the next 5 years.
Eric, can you scroll
Now,
down?
yeah, absolutely. When I taught macroeconomics for 18 years. And one of the things before the financial crisis, the target inflation rate was 3%. If you had 3% inflation, you had an economy that could thrive all day long in that type of market environment. 10% profit margin, 3% inflation, companies can make a lot of money. In the period since the financial crisis, that target has fallen to 2%, because the Fed struggled for years after the financial crisis to generate inflation. So I would consider an expected inflation rate anywhere between 2% to 3% to be ideal for the economy. Now, there's been all this talk since the tariff announcements came out to say, oh gosh, this is going to be inflationary. But if we go to the data and we go to what the market is pricing in, because this number is derived from treasury yields that are being traded in the marketplace, we see a break-even inflation rate of 2.29%, which basically means that the market itself thinks that we're going to see average inflation over the next 5 years of 2.29%. That is just fine in terms of an economy being able to grow. This is not a market that is signaling a concern about inflation right now. Instead, if you go back to when the tariffs were first announced back on, the beginning of April 2nd, and if you go back even a little bit further, we had an expected average inflation rate of 2.61%. The announcement of tariffs didn't cause an increase in concerns about inflation, according to the market. If anything, we've seen a decrease in the concerns about inflation, according to what the market is pricing in. Now, that seems counterintuitive because we've been taught, well, tariffs lead to higher prices, leads to inflation. Well, what this is signaling is that the market doesn't think that the tariffs are actually going to stick at the end of the day. Instead, they're concerned that because of the things that are going on here now, that it may lead to an economic recession, which is disinflationary, if not deflationary, towards the back half of the year. So if in the future, if you go in, you say, hey, I'm hearing all this noise about inflation, you type in 5-year break-even inflation or 5-year break-even inflation rate, it'll bring you to this chart, and you can get an updated number to say, here's where we were when inflation was a problem back in 2022. We were all the way up at 3.5%, 4%. If this line is rising, that's telling you we have an inflation problem.
So, Eric, we had another question on top of that, and it says from Linda, with the national debt increase, should an extended period of inflation be a concern, and what are some ways to protect the real value of a portfolio over time? So,
absolutely,
yeah. The national debt question we knew was going to come up at some point.
Yeah, and the talk about national debt has been out there for years. I remember when I first started out in the industry in the late 1990s and the early 2000s, and the national debt hit $5 trillion. And, certain, economists and market analysts were apoplectic about it at the time and said, $5 trillion debt, how are we ever going to pay that back? Well, here we are 25 years later, and now we have a national debt that's in excess of 30 trillion. So there will be a point where that starts to become problematic. And where that starts to become a problem is when the output that's generated by the economy, or, the economy itself, where is, how well that the money that's coming in from tax revenues for the output that the economy's been able to generate is able to service the interest payments on the debt that the nation has. There are a number of different ways that we can look at this. The best way, once again, just going to the hard data and going to what is the market telling us. I'm going to share my window again. The best read for this is the 10-year treasury yield. And this is one, if you go on any financial news sources, Wall Street Journal, Bloomberg, you'll find out what the 10-year treasury yield is on any given day. One of the things that we've seen, if we go all the way back, let me actually go all the way back to 1981, because it was certainly a different time back then. I'm sure some of you on the call probably remember, in the early 1980s, going to try to buy a house and getting a mortgage, and the mortgage rate for a 30-year mortgage was over 20%. And you go to the bank to open up a savings account, and you could get a savings account that would offer you an interest rate of 14%. Well, that was in part because there was concern about there was a huge inflation problem at the time, but there was also a concern about the fiscal health of the country at the time. What have we seen since 1981? We have seen the 10-year treasury yield, which is the interest rate that the US government has to pay its lenders to borrow money, has dropped from 15.8%, which signaled, hey, there was a real concern about the fiscal health of the United States of America back in the early 1980s, down to as low as a half of a percentage point during COVID. Now, it's come back up to 4%, but this is still relatively low. It's at 4.16% today. This is relatively low. And if we take a look at it in the context, if we zoom in here now and we take a look here over the last few years, we're right in range with something that would be considered to be low and fairly normal. The fact that the US government can go out and borrow money at 4.16% indicates that, at least for now, investors and economists are not worried about the ability of the United States to be able to service their national debt. Now, we have a lot of challenges coming down the road, particularly as we get into the 2030s. We have the baby boomer generation that will be fully into retirement at that point and will be collecting Social Security, as well as requiring, health care through Medicare and Medicaid. So this is likely to become an increasing strain, particularly in a world that is becoming, more geopolitically polarized, with spheres of influence and conflict with countries like Russia and China. So this is something that we need to keep a close eye on. But another indicator that you can watch, the hard data. What's the 10-year treasury yield telling us? It was at 4.8% at the start of the year. It's down at 4.2% now. The market, at least for now, continues to feel comfortable with the country's ability to service its debt.
Awesome. And, kind of on that same trend, we're talking about inflation, debt, and one of the things that came up at a meeting we had earlier today. And I said, well, if you join tonight, we'll talk about this, especially in light of the GDP numbers that came out this morning. Is, stagflation all of a sudden becomes a topic of conversation that feels a little more real. So maybe you can comment a little bit on that, and, what it really takes to see stagflation in action, and how a portfolio may react, and what may be a favorable place to be should there be an extended period of stagflation.
Absolutely. So some other indicators to watch. I mentioned you can put 5-year break-even inflation rate into Google. And again, these are slides in my PowerPoint deck, but I want to empower you as as end investors, as clients, to say, hey, where can I get this information at any given point in time? So I'll take you back out to say, what is the likelihood of a stagflationary scenario playing out here? So a third indicator that can be useful here is if you go into Google and you type in Atlanta Fed GDP now. We have the St. Louis Fed that gives us information about expected inflation. We have the Federal Reserve Bank of Atlanta. So these are government sources of information. They're not part of the federal government. Every regional central bank or every regional Federal Reserve Bank is its own independent entity, and they all publish data. And they give us hard numbers that we can use in order to assess, what is the likelihood? We've talked about, inflationary pressures are under control right now, but we can watch the 5-year break-even inflation rate to see, well, maybe that changes in the coming months. How about the economic outlook? We printed our first estimate of first quarter GDP today, this morning, 8:30 in the morning before the bell. And one of the things that caught the headlines is say, okay, we had a negative 0.3% GDP print for the first quarter of 2025. The technical definition of a recession is 2 consecutive quarters of GDP. Is this the stag part of stagflation that's starting to play out? So one of the things that we can do is we can take a look at the Atlanta Fed GDP Now forecast. Again, this is not something that's based on opinion. It will tell you what the market thinks. And this is the blue line. You see blue chip consensus, range of top 10 and bottom 10 average forecasts. What the Atlanta Fed does is that it takes in all of the economic forecasts from the various economists that are out there, from like Goldman Sachs and JP Morgan and, all the different, Morgan Stanley and all the different banks that are out there. And then it provides a forecast based off of the data itself. And that's the green dot, which becomes a line over time that we see up here in the upper right. We've just had a negative print for GDP for the first quarter, and we'll talk about that in context because that set off alarms for the market, at least in the early part of the trading day. We now have a forecast for the second quarter, and the Atlanta Fed's estimate is based purely off of what the economic data is telling us. And it is uncannily accurate over time. If you track this reading over history, more often than not, they get it right. Even during COVID, they were able to get the economic forecasts reasonably right, just based off of their models in terms of how to interpret the data that's coming out on a weekly basis in terms of like retail sales and industrial production and all those economic data points that you hear. The first thing that we can take away from is that at least for the beginning, the first forecast for second quarter GDP growth, forecasting economic growth for 2.4%. And that is rock solid for a U.S. economy that is trillions of dollars in size. If we can grow at 2.4%, that's doing just fine. Now, what about that negative GDP print that we had for the first quarter here, negative 0.3%? I have to be honest with you. I thought that was a phenomenally strong number for first quarter GDP, despite the fact that it was negative. With everything that's gone on in the first quarter and all of the uncertainty associated with the news flow and the financial headlines and the expected tariffs and the impact on consumer behavior, I would have expected a negative GDP print at like negative 1% to negative 2%. So the fact that we came in at nearly flat, that was a stronger number than I expected. And there's 2 key points to highlight about that first quarter GDP number. Yes, it was negative. That was the first print. There's 3 different GDP numbers that will come out. The first estimate, which comes out at the end of April, the second estimate that comes out at the end of May, and then the final estimate that comes out at the end of June. So this number is going to get revised a bit. But we thought that this number was likely to be negative, and the reason that is because of the tariffs. Now, we haven't had a whole lot in the way of tariffs actually enacted, but people have been hearing about tariffs. I went to get my car washed the other day, for example, and I sat in the parking lot and I listened to a woman talk about the fact that she went and got her Mercedes service at the dealership because she knew the parts costs for the servicing of her car were going to go up. A lot of people did that kind of stuff in the first quarter. When you're doing that, you're buying imports. You're buying stuff from other countries and you're moving forward those purchase of imports to today because you expect the prices are going to be higher in the future. Well, what happens with everybody going out and buying imported goods? That is a number that is subtracted from GDP. It's estimated that all of the import buys that people made in the first quarter of 2025 accounted for up to 5 percentage points of a negative impact on first quarter GDP. which means that if you take away the fact that people were buying stuff from other countries because they thought prices were going to go up, this number would have been pretty solidly positive in the neighborhood of maybe 2 to 3% positive GDP for the first quarter of 2025, which is that's a very good number. So at least at what we're seeing right now, again, it's something we want to keep an eye on, particularly as we go through the second half of the year. If we take a look at the Atlanta Fed GDP Now forecast, is forecasting positive economic growth in the 2 to 3% range. If we take a look at the 5-year break-even inflation rate that's provided by the St. Louis Federal Reserve Bank, we got an inflation rate of 2.2%. This is signaling, the hard data is telling us that despite all of the noise, everything looks fine right now. And that could certainly change, but economic growth looks solid and inflation looks under control, at least where we sit today.
So you alluded to it earlier, and you knew you weren't going to get out of this conversation without talking about tariffs to some extent. So that's obviously been the headline of 2025 so far.
Yeah.
And maybe you could talk just briefly about the market's initial reaction after Liberation Day, why it was so steep and severe, and then maybe comment on your speculation at least of what the future likely holds, and we won't hold you to that forecast, but just comment on that a little bit.
No, absolutely. So one of the things, and basically just to share with everybody what I'm doing here, I'm basically going through the presentation, that the prepared slide deck, but we're going about it in a way, first answering those questions about the economy, about inflation. Now let's take a look at the market impacts. And instead of taking you to the slide deck, because here's the slide deck with a chart of the S&P 500, but this is dated April 23rd. Let's go live here. Let's go with the real-time data. And for that, I'm just going to go straight out here, and let's pop into I'm going to go to a defaulted chart, and then I'll go back to the save chart. Let's take a look at where we are right now with the markets. And we can see here, and I'm going to add a line here, and I'll explain what these lines are. So you'll notice that it's like multicolored spaghetti that's laid on top of the market here. So I'll put a dashed line, and then let's talk about it. So in front of you, you see a black and red jagged line. And these are what are referred to as candlesticks. And this is a chart of and it switched me over to the Dow Jones Industrial Average for some reason. Let's get back to the S&P 500. This is the S&P 500 index going back to last July. The red candles, the little red splotches you see in there, that's when the market goes down. The black splotches, that's when the market's going up. You can see here on February 19th, that's when this S&P 500 hit a new all-time high, 6147.43 on the S&P 500. And we proceeded to go down almost 20% over the course of the next 8 weeks through the second week of April. Now we were descending into the middle of March. We had a bounce. We descended a little bit further, and here we got into the beginning of April here, April 2nd, Liberation Day. The markets were expecting tariffs in the neighborhood of about 10 to 12 to 14% against trading partners from the US against trading partners all around the world. Instead, they got numbers like 46% and 33%, much higher than what the market was expecting. And the market didn't like that at all. And what we saw from Liberation Day, the markets opened on April 3rd, and you can see this spot right in here. You'll see where the 90-day pause was announced. Let me zoom in on this a little bit better so we can see it. So let's go 2025-02-01, so we can take it from the market peak and work our way down. You can see Liberation Day here on the 2nd, and this was announced after the close. If you're going to make a big policy announcement as a fiscal policymaker like the president is, you do it when the markets are closed. Did it after the close. The markets didn't like it at all. Here is the first day, the second day, the third day, and the fourth day after those tariffs were announced. This created a tremendous amount of uncertainty for market participants. They weren't expecting tariff rates this high. And as each trading day passed, institutional investors, kind of the big, asset management firms, we're increasingly stepping back and saying, we don't have any price visibility here. We don't want to trade this right now. One of the things I always say, if there's a hurricane going on outside, you want to stay indoors and not do anything until the hurricane passes. That's what these institutional investors were doing. They're saying, we don't know what's going to happen here, so we need to stand back and wait. Well, the problem is that when everybody stands back and waits, that means there's no liquidity in the marketplace for it to actually function. And that's what was taking place in these 4 days here. With the stock market falling, that's okay because, it's a valuation issue. What really got things changed in a hurry is this chart right here. When the bond market starts to get worked up, and the bond market was okay for the first few days. Here's when the Liberation Day was announced, down treasury yields falling, which means investors were buying more treasuries. There was a flight to safety. The yields fall as the prices rise. Once we got to here, and then all of a sudden, the 10-year treasury yield jumped from 3.8%, 6% all the way up to 4.6% in a matter of days. This is like the type of move you could see over the course of half a year, and it took place over 4 trading days. Once that started to happen, investors were selling US treasury bonds. Well, then the administration had to take action, and that's where the 90-day pause was announced. So it was a tremendous amount of uncertainty. The market started to revolt, and eventually the administration stood down and said, hey, we're going to take 90 days. So the question then becomes, how much sustained damage was done to the markets as a result of these tariff announcements that took place at the beginning of the month? And there's a lot of good news to be had here. So let's start first. We'll go back and take a look at the S&P 500 index. There was a little bit of a process that was going on for the market to regain its footing. Here was the day of the 90-day pause. It was announced in the middle of the trading day. The market continued to rally all the way through the remainder of the week. This is Friday the 14th of April. It pulled back over the subsequent week, but here's where we have a good cause for optimism. The last 7 trading days, the stock market has been moving steadily to the upside. And that's signified by these 7 candles that you see here, all moving to the upside. In the process, the S&P 500 moved above this green dotted line. This is what's known as technical analysis. These are long-term trend lines. And the market will respond to these long-term trend lines because basically it shows where the market should be on average, the green dotted line, any given point in time over a 20-day period on average, or the blue line, any 50-day, any point on average over 50 days, or this red line where the market should be on average at any point in time over a 200-day period. We were all the way down here, and then over the last 6 days, we broke above the 20-day moving average, which is the very first time since the February peaks that we moved back above that line in a sustained way. And now we're closing in. We've returned back to where the market would be on a 50-day average basis. This is positive. The market has shown the ability over the last 6 to 7 days of shaking off bad news, including that GDP print today, to continue to move to the upside. So one of the things to watch for here as we go through the remainder of the month, as we go into tomorrow, given where we are right now, we closed at 55.69, 50-day moving average, 56.02. Can the U.S. stock market, as measured by the S&P 500, continue to advance to the upside? Can it break above this blue line at 56.02 and falling? Can it break above this red line at 56.46 and 57.46 and falling? If we're 2-3 weeks out from now and the S&P 500 is trading at 5,800, 5,850, 5,900, that's telling you as an investor that the worst is behind us, that market participants were able to shake off what took place in the beginning of April, and that there is confidence to continue to move this market higher in the months ahead.
Yeah, and if you guys remember, for those of you that were on our January call, the world looked a lot different only 3 months ago, and it was almost 3 months to the day that we did this. And one of the things that we talked about at that time was how the market was steadily above all these trend lines that you see here. We were way above all of them. And the argument there was the market's overdue for a correction. We just don't know how it's going to manifest itself. And of course, things continued to go up until about mid-February, and then they fell off. But to illustrate the point, not that technical analysis is the end all be all when it comes to seeing trends and predicting what's going to happen tomorrow. But you could see that when the market topped out at 61.47, we were well above every single moving average that we had. And the tariffs were kind of a shock and awe event for sure, but it's normal to see things kind of sell off and get some excess removed. So usually there's a catalyst for that. In this case, it was a catalyst maybe bigger than we all thought, hence the really steep reaction. But by and large, the market is just regaining its footing and getting back to a place where I think market participants are a little more comfortable.
It's why I always love doing these calls with you, Paul, because you always raise the great points, because you're absolutely right on this. The market was so overdue for a pullback. I would actually consider, although it was disorderly there for a stretch, the market pullback that we've seen since February 19th, it is not only a healthy thing, but it's actually a good thing because it's helped bring the market back to its averages. It's helped take some of the froth and some of the steam out of this market. And I'll put this in the context to Paul's really good point. If we go back to the middle of July, some of the things we were talking about in January, here's the S&P 500 at 56.69 and way above all of these way above all these lines, the green dotted line, the blue line, the red line, and the pink line. All these lines should converge with themselves and kind of be close to each other over time. They were all way above each other. This is telling us we're way overdue for a pullback. We got a little bit of a pullback in July into early August, but then boom, the market was up off to the races again. I always like to say the stock market is something that should move 3 steps forward, 1 step back. But going all the way back to Halloween of 2023 up through the middle of February 2025, it was basically 15 steps forward, no steps back. There was really no sustained pullback in this market. So we were long overdue for it. And what has come out of the last 8 weeks from the middle of February to the middle of April is we washed out a lot of those excesses and a lot of the misallocation of capital. Where are we today at 55.69? We're basically in line where we were back in July. But we have gone through a healthy consolidation in the process that sets us up for what could be a potentially good second quarter of the year and potentially a good remainder of the year at this point.
Awesome. And Rob, I see you got your hand up. Feel free to unmute yourself and ask a question or fire it into the chat.
Yeah, so it sounds like, you seem to be implying that the tariffs have not had really any noticeable long-term effect. Is that what you're trying to communicate?
Yes, I would say at this point now, there's still a lot that needs to be digested. And, the thing that really upset the markets, there has been some tariff impacts. Like, for example, in our first quarter GDP number, consumers brought forward their purchase of imports today because of expected higher prices in the future. A key point on the tariff front in the months ahead, and it's something that we'll learn a lot more in the next 90 days. Where does the tariff numbers end up with their various trading partners at the end of the day? The market was prepared for, a 10% across the board tariff or in the neighborhood of 10% across the board tariff. A lot of things that we were hearing from corporate CEOs prior to Liberation Day was that, hey, you know what? Our business is pretty strong and, our outlook is favorable. We just need to know what the number is that we need to plug into our spreadsheet. And we, over time, we believe, just like we saw with tariffs implemented during the first Trump administration, the market adjusted to those tariffs that were placed against some, China and some of our trading partners. The expectation was that the market would adjust again. And, this isn't, this is a phenomenon. You can go all the way back to, Greece 2,000 years ago and find examples of tariffs being imposed on trading partners that can, even be retaliated, but the market adjusts. And that was what was setting up. The thing that we need to watch over the next 90 days in this 90-day pause period is, do we come to some sort of rational and orderly outcome? And my expectation, at least today, is that that will be the case. That there will be an impact from tariffs that could have a marginal inflationary effect. It could have a marginal depressing effect on growth, but nothing that would be disruptive to markets or disruptive to the economic outlook or disruptive to the inflation outlook for that matter. It will be a key theme to watch, but and this goes more to the Treasury Secretary than necessarily the president. I think there was a realization, there's a lot of signs that suggest that there was a realization based off of what took place during that period in the first 2 weeks of April, that it was too much, and that they're likely to be much more measured in how they resolve this from here, based off of what that experience was, because they had a real market problem unfolding there for a couple weeks before they finally stepped back, and I don't think they're going to want to repeat that. So with that in mind, coupled with some of the other things that we'll be talking about for the rest of the call, at the end of the day, it's a kind of a base case expectation that in the second half of the year we'll look back and say, well, that wasn't as calamitous as we were anticipating it might be as we sat in the beginning of April.
Well, I think we all hope that's the case.
Yeah.
So I see another question here in the chat, and I guess it says today Powell did not have confidence in the growth of the economy. I'm not sure, Wayne, if that's with respect to consumer confidence. I didn't hear any remarks from Powell today, or even recently this week. It says, can you shed light on this? I don't know if you've heard anything, Eric.
No, it's a great question. I mean, and there's a reason. There's a reason why you want to see your central bank maintain independence. We have to look no further than countries like Turkey, for example, where if the fiscal policy executive starts to assert undue control over monetary policy, that can lead to unfavorable outcomes, because there's conflicts of interests that come into play. And that was one of the things that caused the markets to be on edge at the beginning of last week, is that you had comments that were, kind of imposing on the independence of the Federal Reserve. You want your Fed to be independent because you want them to do the things that they need to do based off of what they're seeing without any imposition. If they're seeing an inflation problem, you want them to have the flexibility to combat that inflation problem, because once, as we saw in the 1970s, if inflation gets out of control, it can be a real problem. And we see it in a lot of other countries around the world today. At the same time, you also want them to have the flexibility, if they need to cut interest rates, to not have it be perceived as something that they're doing under political pressure. You mentioned absolutely. It's just, Powell he has concerns about the growth outlook for the economy. And rightfully so. That's what the 5-year break-even inflation rate is signaling to him, is that there could be the potential for an economic slowdown in the second half of the year. One of his concerns is that, these recent tariff announcements, by nature can be inflationary, and, tariffs, inherently are inflationary. Could we encounter a situation in the second half of the year where we're in a stagflationary scenario that forces the Federal Reserve to have to take a deliberate, they can't be preemptive in cutting interest rates. This isn't COVID of 2020 where that was a deflationary shock to the economy. They could cut interest rates to zero and engage in, asset purchases, quantitative easing, and stimulate the economy all day long. They're not in that spot right now. They have to wait. They have to be deliberate. If the tariff issue continues to fade into the backdrop at a time when the economy is showing signs of slowing, the market is actually, let's take a look at this. So you'll hear all these comments about how much is the Federal Reserve likely to cut interest rates in 2025, and you'll hear all these opinions on it. Once again, I like to go to the data. So I'm going to take you back out to the slide here. I'm going to give you one more here, and I'll put it into the chat because I know it's a lot to take in. If we want to know what the market is pricing in right now, you can type in CME Fed Watch, and I'll put this into the chat later on in the call. You type in CME Fed Watch, and it will take you to a chart that tells you price is truth, what the market is pricing in terms of the number of Federal Reserve rate cuts. Now, you have to do a little bit of eyeballing here, Like, for example, the Fed has a meeting coming up here next week on May 7th. The current Fed funds rate, it tells us down here, 4.25 to 4.5%. It is very unlikely the Federal Reserve is going to cut interest rates here in June, only a 6% chance, according to the market. Or that's in May. But in June, the market expects that the Federal Reserve is going to cut interest rates in June. What does this tell us? This tells us that by the time they get to their meeting that's scheduled for June 18th, the tariff noise is likely to have faded to the backdrop. That will probably hear some trade deals that were cut with Vietnam and with Cambodia and with India, and there's some confidence that, hey, okay, this issue is now getting behind us, and that we will see sufficient weakening of the economy, not necessarily a recession, but sufficient weakening of the economy that the Federal Reserve will feel the flexibility to lower interest rates by 0.25 percentage point in June. And if we go out to the end of the year, so you can see there's links up here, the June 30th meeting, the September 17th meeting, the October 29th meeting, the December 10th meeting, all of the rest of the Fed meetings. We're currently at 4.25 to 4.5%. Basically, all we have to do is look at this chart and say, where's the biggest bar? The biggest bar right here is at 3.25 to 3.5%. That's telling you that by the end of the year, the market thinks that the Federal Reserve is going to cut interest rates by 4 quarter points or 1 full percentage point between now and the end of the year. What's the only way they're going to be able to do that? Is if inflation is under control and the Federal Reserve itself, through their independence, feels the flexibility to be able to do that. So that's and the reason that's important and the reason that's meaningful, not only for the stock market outlook, but also the bond market outlook. And even if you're an investor in like precious metals, like gold, there's nothing more than the market likes, and we've seen this since the financial crisis. There's nothing more that the market likes than liquidity. And where do they get liquidity? One of the places they can get a lot of liquidity is when the Federal Reserve is cutting interest rates, because it means that market participants have a lower cost access to the money that they want to access in order to invest it in the market. So lower interest rates historically have implied higher asset prices, which is positive.
So speaking of being invested in the market, I think that's a nice transition into, kind of what we're doing within portfolios and some of the moves we're either making or not making really in response to what's happened so far this year, and some things that we have on the horizon more at the asset class level. We don't need to get too deep in the weeds, but I think it'd be interesting to comment on that and why we've done things at the investment board level that I sit on with you, and why we haven't done things. So
Absolutely. Yeah. So one of the things that I'm going to do now, and it's, one of those without, we've covered a lot of the materials that I was going to show you in the slide deck. I'm actually going to go to the slide deck now because there's a key chart that is really important in terms of what we're doing from an asset management perspective, in terms of how we're managing the portfolios going through the remainder of the year. So there's a chart, and I'll put it into a slideshow so we can see it a little better. Another big concern, because we had people talking about stagflation. We talk about the threat of inflation, talk about the potential for the economy slowing down. One of the biggest keys for the U.S. stock market to rise, and this is particularly true for the S&P 500, which is your large cap stocks, is you need to see corporate earnings rising. I'll go to the next slide to kind of show you the importance of this. So get this to click through here. There is a tremendously strong relationship over long-term periods of time with companies in the S&P 500 making money in terms of earnings and the price of the S&P 500 itself. Corporate earnings are shown in this orange line here. It's the S&P 500 12-month trailing GAAP earnings. So that's not adjusted earnings. That's just what they're reporting on their financial statements. This orange line is earnings. And one of the things that you'll notice, the blue line is the S&P 500 index itself. One of the things you'll notice is that as this orange line is rising, the S&P 500 tends to rise. And when this orange line is falling, the S&P 500 tends to fall. We saw it during the bursting of the tech bubble. We saw it during the financial crisis. We saw it in the mid 2000s when we kind of had a bursting of the energy bubble. We saw it during COVID. We saw it during the 2022 inflation outbreak. Here's where corporate earnings have been projected. It is moving sharply to the upside. And that's very positive for stock prices. We talk about stock prices being ahead of themselves. Here's where we were in February. Hopefully you can see my cursor. Here was where we were in February before the market corrected. Notice that the blue line, and it gets green here because this is based off of forecasts through the remainder of 2025. The blue line was way above the orange line. It meant that the stock market was ahead of itself. The earnings needed to catch up. Where have we fallen back to with the correction that we've seen in February, the second half of February, March, and the first half of April? The blue line has fallen back to what is the green line, which is projected earnings. So as long as corporate earnings are forecasted to rise, that's very positive for stock prices. It's particularly positive for U.S. large cap stock prices. It's also positive, and this is also positive for international stock prices, which we'll talk about in a minute. So the key then is, what are the 500 companies in the S&P 500 forecasting for earnings growth for 2025? The blue bars you see in this chart were the forecasted earnings growth, which turned out to be the historical earnings growth for 2024. And we see earnings grew in the range of about 8 to 10% in 2024. And 2024 was a fantastic year for the S&P 500. It rose, and it got a little ahead of itself in the process, but it was a great year. The dark red lines, the dark red bars that you see here, they were the forecasted earnings for the S&P 500, the 500 companies. So this is coming out of the mouths of the CEOs and CFOs of the 500 companies that make up the S&P 500 index. It's a great sample in terms of forecasting what you can reasonably expect through the remainder of 2025. The red bars were what companies were forecasting coming into the quarter. This is as of March 31st. Very strong, mid to high teens in terms of earnings growth. That implies a stock market that wants to go higher, all else equal. Now, one of the big concerns that investors had going into first quarter earnings season, which is basically started last week, and we're about a third of the way through it now, would companies revise their outlooks lower because of all the tariff uncertainty? And what has been notable to me as we've gone through earnings season so far, this orange bar is what current earnings forecasts are after 1/3 of companies in the S&P 500 have forecasted earnings. We have not seen a situation where corporations have cut their earnings forecasts because of tariffs. Instead, we have seen companies increase their earnings forecasts and increase their guidance through the remainder of 2025, despite all the tariff uncertainty. This is tremendously constructive in terms of supporting higher stock prices, particularly in the US large cap area of the market. And that's not only true for growth stocks. 2024, it was all about the Magnificent Seven and these technology stocks that got these outrageous valuations. This is true for all stocks. So, in terms of how we're allocating from a portfolio perspective in the GVA models, we're allocating to growth, but we're also giving equal allocation to value, because value is an area of the market that has kind of been left behind in recent years and offers attractive value. That also feeds its way through to mid cap and small cap stocks, which have struggled more than large cap stocks. So, maintaining an allocation to mid and small cap stocks in the US. And on another element here, taking this one step further, I'll kind of punch down here on the slide. This is the inflation chart. I told you it was in the slide deck, so this is just proof that it was in there, except I gave you a more updated number. We continue down here. International markets. Investing outside of the US has been, a challenging experience for investors in recent years, because the US has done so much better than the rest of the world for years now. And, really going back to 2010. And so, investors have been rewarded for having a US bias. But the question has become all along the way. So, wow, look at the tremendous value that exists in non-US stocks relative to the US. But it's been an exercise in frustration trying to capture that. But one of the questions, and one of the things that we're starting to see unfold as we go through 2025 is that time may finally have come. Whereas the US stock market is still down meaningfully year to date, still down high single digits year to date, developed international stocks are up by nearly 9% year to date. It's been a great start to the year for investors outside of the US. One of the primary drivers of that strong performance has been the movement in the US dollar. So if the US dollar is strengthening, that's bad for developed international investors, but it's great for US investors because it means that when the money is getting converted back to US dollars from overseas, you have to pay a higher exchange rate. It's dampening the returns outside of the US. On the flip side, if the US dollar is falling, that's great for developed international investing relative to the US because that means you're getting an added boost to your returns when you bring that money back to the US and you can exchange your earnings you made overseas, at a lower exchange rate to turn it back into dollars. We take a look at this chart. I mentioned 2010, US has outperformed international. Take a look at the dollar index. We were down here in the 70, 75 range, and we saw a dramatic steepening in the US dollar, the strengthening of the US dollar over this entire 15-year time period. One of the things that preceded that, however, the period from 2001 to 2008, this is a period where developed international stocks meaningfully outperformed the US. How did they do that? Because there was a dramatic weakening in the US dollar index. Where are we right now? Well, we've seen a dramatic weakening in the US dollar index so far in 2025. And there's good reason to think, particularly if the Federal Reserve starts cutting interest rates, that we could see that dollar weakening further. We increased our weighting to developed international. We increased our weighting to emerging market stocks. So this is your countries, that are more developing economies outside of the US, like India, for example. We did that in part because of the dollar strength, the value that existed outside of the US, and the long overdue opportunity that exists for the returns that can be generated when developed international catches up to the US. And we may only be at the very early stages of that. So that's something that we're looking at to say, maybe it's time to increase that weighting even further as we go through 2025 and into 2026. So those are just two examples of, the things that we're seeing unfold in the markets and how we're adjusting to them in terms of how we manage the model portfolios.
And I think that's been reflected. A lot of times the reaction's been, especially in meetings these past couple of weeks when, inevitably this stuff comes up, when people say, it's really not as bad as I thought it was when I actually looked. Kudos to those that are, staying disciplined and not freaking out when the markets are down. But, aside from that first couple of weeks in April where really everything melted down pretty quickly, this was a really interesting kind of realization for folks to actually look at the numbers and say, wow, Mark at US S&P's down, meaningfully, but I may be down 2, 3, 4%. That's not that bad. That's something I can stomach. And, for years we've been touting diversification and all these things that seemingly didn't work really that good. Talk about an exercise in frustration from an asset allocator and a risk manager standpoint. But, bonds have performed poorly over the past several years. International stocks have been a dog relative to US. Even US value stocks have been pretty lackluster compared to the growth space that's driven the market so high. So, when you guys are starting to think that we're crazy to telling you got to own some of this stuff, and there's good reasons why, we may, and asterisks all over the place when I say may, but we may be in an environment to start seeing diversification work a little bit better and start seeing these other asset classes that have relatively underperformed the United States large cap space actually provide meaningful returns within your portfolios. And, that's always our hope with diversification. But, we're starting to see that manifest itself now. And, I think you'll get that similar answer from just about any financial advisor that believes in diversification, which is pretty much anyone. So we all kind of operate under the same thesis there.
Yeah, the one thing that I always like to say is that a well-constructed asset allocation model is one that is prepared for market environments like the one that we've been through here since mid-February to mid-April. And if it is constructed properly, if you protect against downside risk first and then seek to optimize return on that downside risk framework. When the hurricane finally ends, like it did in the middle of April, it gives you the opportunity and that level headedness to then be able to go out and say, okay, in the damage that's been done here, where is the opportunity? Where is the upside? Where is the dislocation taking place that we can position to capitalize on? And that's really the environment that we're in right now. And I suspect that we'll probably continue to be in that environment, as the coming weeks, as the market continues to sort all this out.
Awesome. Well, Eric, I feel like we should open it up to additional questions as we're hitting an hour now, and I don't want people to feel like they got to stick on with us all night. But, if anyone does have a question, feel free to unmute yourself and just fire away or type it in the chat. We're happy to tackle that.
Yeah. And as you may be thinking about questions, if there are questions that come up after our call, always feel free that, any questions for me, that is, because, Paul's a great partner in terms of the investment work that we do. He's on our investment board and has tremendous insights. But if you do have any questions for me, let Paul know and you can always pass them along.
So as we sit here on April 30th, and coincidentally today is Trump's 100th day, this was just kind of dumb luck on our, scheduling calendar, but we'll take it sometimes. We know volatility is not fun. We appreciate you guys and everything that you do to, keep your trust in us through the turbulent times. I sometimes don't say that enough, and I should say it more because it's not easy to do, especially those of you that may be in retirement or just approaching retirement, where, you feel like, hey, this is all I got. And I need it to work, and having trust in the process, having trust in markets, quite frankly, over the long term, and staying the course, and leaning into the planning work that we do when we're talking about budget, cash flow, and withdrawal strategies, I think really plays into hopefully giving you guys confidence to, feel that way and know that we're here as a resource. Obviously, Eric is a phone call away, and, we want to try to be as good as we can on communicating without honestly over communicating, because we could have written a new article every single day this month.
Yeah.
And it's just the flow of information is unbelievable at points in time, and this has certainly been one of those times. So if there is something that does come up, major market movement wise, we'll certainly schedule another one of these, and definitely never hesitate to reach out to me and the team for any questions that you may have. And again, we appreciate your trust in us and everything you do for us. So with that, Eric, thank you again for your time, and I really appreciate you coming out as well, because without this, and your insight into the charts and the hard data, I don't think people want to hear me talk for an hour on that. I'd be fumbling over my words and everything. So, it is greatly appreciated on all fronts. So thank you again for the time.
No, Paul and Preston, thanks so much for having me on board, and thank you to everybody. This is I've had the opportunity to do a couple of these now, and I really enjoy the opportunity to be here with you today, and a lot of great questions that were asked along the way too. So I really appreciate it.
Paul and Eric, thanks. My chat, I haven't been able to use my chat, but keep up the good work. This was very informative, comforting, and stabilizing. So thank you.
Well, if a tweet comes out tomorrow and upends all this, it's not on us.
Take care, guys.
Be good.
Thank you.
Thanks, everyone.